No change in rates as expected from the RBA, and overall it was a positive week for economic data, giving the markets and the Aussie dollar a leg up, and adding to some positive sentiment as spring brings us out of hibernation. The best indication of the improvement in conditions locally was the GDP growth, which came in at 0.5% for the quarter, making our annual growth rate 3.3%, which, as the chart shows, was helped by a pickup via the public sector, with government consumption and public investment on the rise. Private demand dipped to 2% year on year, but incredibly, this all marks 25 years of uninterrupted growth, closing in on the 26.5-year world record set by the Netherlands from 1981 to 2008. The recession of 91-92 here is a distant memory. Other positive data this week included a rise in the ANZ Job Ads Index, up 8% year on year, which should keep our unemployment rate in the 5.5% to 6% band. And also company profits were up 6.9% in the second quarter, which matches some of the progress this year in our stock market, up over 10% from the February lows, but still some distance from the crucial 6,000 barrier from last year. Overseas, the mood from the United States has soured a little after a poor read in their non-manufacturing business activity index, on top of the soft employment and ISM manufacturing figures last week, which has pushed the greenback lower and so the Aussie dollar and the New Zealand dollar higher. The Kiwi is back eyeing off parity with the Aussie, so with the recent recovery in milk prices, we'll see if this cross rate finally breaks parity, having got so close April last year. But we still expect the Aussie to edge a little higher for now, which should keep our premium intact. And finally, auction clearance rates remain elevated, so housing prices appear well supported. Although the recent building approvals rise was mainly centred on new apartments. So with a sharp rise in apartment supply coming next year, the outlook for the property prices may be best considered by these distinct segments, and we'll no doubt see considerable variances state by state and city by city. For us to beat that 26.5-year record, we need to avoid a housing bubble and a bubble in China. For now, China looks the bigger of those two risks. And that's the market update from Bendigo Bank.